Hello, good morning. I'm Derek DeCluet. I'm the Canada Managing Editor from Bloomberg. On behalf of Bloomberg, I'm so pleased you could join us for the first session of the Bloomberg Canadian Fixed Income Series. This conference is the 8th annual event of its kind, bringing together the biggest names in Canadian bonds, credit, commodities, and more. We're really sorry we could not be in New York this year, so we've transformed this event into 6 virtual briefings, which will take place over the next month. We hope you'll check out the agenda section of the website for more information on the next events in the series, which after today start again next week. To kick off today, we're taking a deep dive into the Canadian economy and financial markets. The COVID-19 pandemic has ushered in a serious global recession, and Canada has felt the blow as much as any developed economy. So as the country plans its recovery, we'll hear from insurers, asset managers, economists, and more on the opportunities and challenges that are ahead. But first, I'd really like to thank our sponsor, National Bank of Canada, for helping to make this virtual event possible. We really appreciate the bank's support this year and every year. Before we get started, I have just a few housekeeping announcements. If you experience any issues with audio or video quality, just try to refresh your browser or use the chat box on the bottom right-hand corner of your screen for support. You will be able to submit questions to the speakers during the interviews, and we'll get to as many as we can. To submit a question, click open on the white tab on the right-hand side of the video window and submit your question. And if you put your name and where you're from, we'll give you a shout out. Please engage with us on Twitter and other social media platforms using the hashtag BloombergCFI. And I'd now like to welcome Mr. Hawar Nazim, the Deputy Consul General of Canada in New York. Over to you, sir.
Thanks, Derek. Good morning, everyone, and thank you for that kind introduction. It's an honor for me to be with you this morning in advance of what will be a great array of panelists and speakers. C'est un grand plaisir et honnêtement un honneur d'être parmi vous ce matin. I want to start by thanking Bloomberg for hosting this conference, as Derek mentioned, now in its 8th year. And I want to give a special shout out to our friends at the National Bank of Canada for their sponsorship and inspiration. You know, having participated in these in past years and entering the Bloomberg building on an annual basis, I know we all wish we could be together for these discussions. If there's anything I've learned over the course of this pandemic, it's that people are hardwired to be social. And 6 months into this, talking through screens all day still does not feel natural. I can assure you, promise you, that I am much jollier in person. At the same time, I think we've all gained a deeper appreciation for technology, which has allowed us to find ways to continue exchanging ideas no matter what life throws at us. And given the disruptive effects of COVID-19 has had on our economies, these discussions have never been more important. Now, for me, New York is my 6th international posting, and it is honestly a privilege to represent Canada here. In my role as Deputy and now Acting Consul General, I appreciate and rely on the array of tremendous partners we have, like Bloomberg and the National Bank. For no other conference in New York offers such an in-depth look at the Canadian economy. I've been living in New York for nearly 4 years, and when asked, indeed, if you know me, often without even being asked, I tell my friends that New York represents the strength, ambition, and resilience of America and Americans. This rings particularly true during the month of September when we commemorate those lost on 9/11. New Yorkers have a particular way of showing solidarity, one that was cemented in the aftermath of the 9/11 attacks. Coming together, resuming a sense of normalcy, and heck, going to Broadway shows 2 days later. Of course, the COVID pandemic has demanded a different type of solidarity, one that runs, in fact, counter to the New York model of familiarity, of density. This new formed solidarity requires masks on everyone all the time, empty subway cars, shuttered museums, and outdoor-only restaurants. But as always, New Yorkers showed that they can meet any challenge. And now the city, which was once the global center of the pandemic, has had more than a month of a rate of infection below 1%. COVID-19 really is the challenge of our generation. From the moment this pandemic began, the Canadian government understood the imperative of supporting Canadians through stabilizing the economy through a range of support measures. The emergency response benefit, for example, has provided support to Canadians who stopped working during COVID. The Canada Emergency Wage Subsidy helps Canadian businesses retain workers and rehire those that were laid off due to COVID. This was just extended until next summer. The government also provided interest-free loans to small businesses to help cover their operating costs during this difficult time. These actions, in addition to a broad range of targeted support for students, seniors, and other vulnerable groups, have been necessary to get Canadians through this crisis. Now, one of the first rules of giving speeches is to know your audience. And I know my audience, and I can imagine all the calculators coming out and brows furrowing, and I certainly don't want to ignore that. Yes, there is a cost to these actions. But the bottom line for Canada is that we have put in place a comprehensive response plan while at the same time maintaining a low debt advantage. We came into this crisis on a strong footing with a net GDP to debt ratio considerably lower than our G7 peers. By acting quickly and extensively, Canada avoided a deeper and costly downturn, which would have had a detrimental impact not only on jobs and incomes of individual Canadians, but also on government revenues. Later in the fall, the government will update on the economic and fiscal impact of COVID-19. For those of you who watched, yesterday's speech from the throne made our government's commitment to creating a more sustainable, equitable, and resilient economy, including through strong climate action as a cornerstone for job creation. Now, one of the areas of real concern for Canada is that this crisis has exposed and indeed amplified many inequalities in Canada. It has underscored systemic barriers faced by Indigenous and minority communities and disproportionately impacted women, particularly low-income women. Drawing on the words of the Governor General yesterday, we must not let the legacy of this pandemic be one of rolling back the clock on women's participation in the workforce. For all the disruption it has caused, the pandemic has given us pause to reflect and engage in meaningful conversations about the kind of society we want to build. Our government recognizes the importance of pursuing inclusive and clean growth and ensuring that no Canadian is left behind. And while some may be struggling on how to get back on their feet, we know that there are others who have managed to grow through all this. And for them, I hope it is clear that Canada remains one of the best places to invest. Our highly skilled talent, low tax rates on new business investment, thriving innovation ecosystem, and top-rated quality of life continue to lead world-class companies to choose and grow in Canada. Investors also benefit from Canada's unique ability to bring global talent to Canada through a simple, streamlined process and many innovative policies designed to make Canada accessible to skilled workers. Finally, Canada also means that companies gain preferential access to 51 countries with nearly 1.5 billion consumers through 14 trade agreements. One of those agreements, the Usmca or Usmca or NAFTA 2.0, I know everything about that one because it's all I've really talked about for 3 bloody years. It was ratified earlier this summer. The Usmca provides stability and predictability in a time of turmoil. It offers a renewed platform to improve the resilience and shortening of our supply chains, which have proven so important in the COVID era. It will help fuel Canada and North America's potential as an energy manufacturing and innovation powerhouse. We welcome the decision by the U.S. administration to remove tariffs on Canadian aluminum, which were not only unwarranted, but also a hindrance to our growth as partners and to our consumers at a time of economic challenge. Now is the time to advance North American competitiveness. Now is the time to strengthen the integrity of our supply chains, which have ensured that people in both countries benefit from predictable and supply of food, consumer goods, and critically, PPE. Now is the time to chart a joint path forward towards recovery and greater prosperity for our citizens. Because as we continue to face so much volatility and uncertainty, there is one thing we know for sure. No matter the challenges ahead, Canada and the United States will fare better if we address them together. Thank you, merci, and I look forward to the rest of the program. But back over to you, Derek.
Thank you for joining us virtually for this discussion on the Canadian economy. My name's Shelley Hagan, and I'm a reporter with Bloomberg News covering the Canadian economy from Ottawa. We have some wonderful panelists today, including Beata Caranci, Chief Economist at Toronto Dominion Bank, Jean Boivin, Global Head of Research at BlackRock, and Stéfane Marion, Chief Economist at National Bank Financial. So needless to say, for those of you who joined us at last year's conference in New York, this global economic backdrop couldn't be any more different given the pandemic and the devastation it caused worldwide. So I'd like to start off with a discussion from Jean on what he's expecting over the next 1 to 2 years for the global economy as we recover the pandemic. So what, Jean, is your global outlook?
Great. Well, thank you very much for having me. I'm very delighted to be here. So I guess a couple of key observations I would make at the onset. The first one is, this shock is of a different nature than a typical cycle. I think that's very important to put out at the onset. As a result, the near-term impact has been unprecedented, and we've been already going through this. But it is one where the restart is real. I think we are seeing that happening now globally. It's been happening somewhat faster than even we had been expecting. And even like a few months ago, we were in a world where we were expecting to be back more or less at the level we were pre-shock, or like at the beginning of this 2020 year, at the end of 2021. So I think that frames a bit how we're seeing the global outlook. It's one where a very deep shock for now, but one that we're recovering eventually over the course of the next 18 months. But that's predicated on a few things. I think the trajectory of the virus is what it is, and we'll see some flare-up. So we see that as being part of the outlook that I've already described. So it's not one where the virus stays under control, but we have some flare-ups. But what is really crucial is we get the continuous policy support that has been expecting, and there's bigger risks. And in particular, I would point to currently in the U.S., difficulties in reaching an agreement on the fiscal side. And there's a bit more now of a risk that we're going to see an early retrenchment of the fiscal support. So the story I've provided here, the outlook we have is predicated on eventually getting ongoing support, but there's a risk, downside risk to this. But again, it's not 2008. We're talking about a cumulative shock that is a fraction of what we've seen, post-global financial crisis back in 2008.
And we do actually have to take one question from the audience, which is on when Canada's economy will fully recover from this recession. And so what is your timeline on that? And if all the panelists can just give a short timeline for that.
I think this is really a global shock. I mean, the policy response in Canada, I think I have a greater confidence or a bit less downside risk to it. So that would mean more or less the same kind of time frame, sometime in 2021, where we're back to the pre-recession level, maybe with a slightly greater level of confidence than I have in the U.S., given the policy landscape being a bit more certain.
And Stéfane?
Yeah, it's a tricky question because I think GDP will be back to peak before employment, but that could be a 2021 story, but for employment, it's not before 2022, which will bring tremendous challenges to policymakers. So GDP, perhaps, employment's going to take a while, 2022.
And Beata?
I would agree with what Stéfane said on differentiating between economic output and the labor market scarring that will persist. I'll just add one positive note, though. We had two really large revisions to forecast by two institutions last week, the OECD and the Federal Reserve. Both of them did massive upward revisions to their economic outlooks and their unemployment rates, to the point where the Fed now is actually more optimistic on unemployment than consensus. So making the point that we're all taking a little bit of a stab in the dark.
And Beata, I did want to touch on a topic on the central banks, and what we've seen from this pandemic is central banks, including the Bank of Canada, have committed to keeping interest rates low for a long time until the economic recovery is fully underway. And so there's been a view that central banks might allow inflation to run hotter than usual before raising rates. How do you think this could affect Canada, given the trade-off between raising rates and, of course, the high household debt levels that we have here in Canada?
Well, first I would say the burden of proof is going to be on inflation, because basically we've had inflation chronically below 2% for the last decade. If you look at the Bank of Canada's three metrics that they follow, they were averaging between 1.6 and 1.8 for a decade. So while I think we would, the central banks are would prefer that expectations rise above 2%, that is a high bar given what we've seen in the last decade. Ultimately, they don't manage debt based on what they do with interest rates. What they're after is the holistic view of the economy. A byproduct of that is inflation. So if we get greater labor market scarring, we end up with a cycle that is much more belabored than would otherwise be the case from the central bank. So for us, we don't actually think the central bank is going to be raising interest rates to 2024. So that's quite a ways out. And that in itself helps to manage the debt burden, but that would not be their intent. So just to give you a really quick example, someone who's buying a house in Toronto now, average price $900,000, up 11% in the last year. Relative to someone who bought last year, they're going to pay about $7,000 less in interest costs over the next 5 years. And as people renew their mortgages who bought 5 years ago, they're going to be paying between $10,000 and $15,000 less in interest costs over the next 5 years. So part of this becomes self-fulfilling just because the economic backdrop won't be strong enough. There won't be enough of capacity eaten up for them to raise rates.
And Stéfane, where do you see inflation heading?
Well, I think it's an interesting issue because if you look at the nature of this recession, this is the first recession on record where households have yet to experience a negative wealth effect, if you look at financial or residential assets. So that means that there's no deleveraging that has taken place. This is very unusual. So there's some resilience on the inflation scope on that one. Jean mentioned the necessity for policymakers, for fiscal policy to continue to accommodate the reflation trade that central banks are very keen on. So I do believe that one of the key characteristics of this recession is there will be capacity destruction in sectors where people are not necessarily have a high home ownership rate. So you protect deleveraging on that front. I do think that because of partial destruction of capacity in certain sectors, there's a higher natural rate of unemployment in the aftermath of this pandemic, which means that you can get stickier inflation. So I think that unlike 2008, 2009, with fiscal policy moving with monetary policy, I think that the 2 to 3% inflation world is possible to achieve under these circumstances. Keep in mind at the same time that I have this economic Cold War between China and the US, and I will have a fight against climate change that is inflationary by nature. So under these circumstances, I think the 2 to 3% range makes a lot of sense for the next couple of years.
Well, one area I did want to touch on that has been a bright spot throughout this whole pandemic is the Canada housing market. And it seems to defy all odds and really driving growth in Canada. But where does it go from here, Beata?
Well, clearly this is one area where economists underestimated. We were one of the more optimists on the street, and yet, what we're seeing in the market just blew away everybody's expectations. So there's a couple of things that, forecasters got wrong, and you'll see it in a graph that will come up, basically showing you our equation for home sales and what happens when you substitute the income side of the economy for a way instead of unemployment rate. So traditional home sales models will often have the unemployment rate as a key predictor of sales. Take that out and put in income, you get completely different trajectories for where sales are predicted to go. And that's because income is not behaving as it should with an unemployment rate of around 10%. And that's because the job market has been distorted to those who are on the lower income side in terms of job losses, whereas it has been highly preserved on the income side for your middle and upper income, in addition to the government supports. So that's the first pillar that would have to fall for us to be in a bear market on housing. Either government supports would really have to dry up, which is unlikely, or you would have to have a much more wider distribution of job losses across the income spectrum, which is not in anyone's forecast at this stage. So that suggests that there's some resilience to the housing market. And the other factor that we underestimated was the impulse to demand from the interest rate shock that happened when mortgage rates dropped. We knew there would be an impulse there. However, pent-up demand was far greater than we could have anticipated, likely coming from the millennial generation, and it's not unique to Canada. We see the exact same phenomena happening in the US and in the UK, and in fact, the US home prices are rising at a rate of 11%. There's supply shortages in certain segments of the market there, like they are here, especially in the hot markets like Toronto. You are seeing very tight supply in the detached market, and this is lifting those average prices. So, where to from here? It's obviously not sustainable at the rate we're going. You can see in that graph that we level off in sales because affordability will continue to erode, moving away the advantage of the low interest rate environment. But the detached market is extremely tight. And so it's going to be very difficult to have bargains in that side of the market. And where we expect to see price compression is really on the condo side, which is having a lot of building activity. And there's a lot of supply from people having put their homes on the market. And those are not substitute products necessarily, because where you're seeing supply on condo, these are 600, 700, 800 square feet. And those are not necessarily the same buyers that you get on the detached side.
So it's resilient for now. But one risk moving forward that I've been hearing about is how we're basically having zero immigration in Canada. And of course, immigration has been seen as spurring the housing market. So Stéfane, what do you see as the implications of zero immigration in Canada in the short term?
Yeah, so the immigration policy will break or make Beata's forecast, by the way. So you have to understand that Canada remains an economy that is essentially driven by labor force growth as opposed to productivity growth. And that comes from an immigration policy that is skewed to highly educated young immigrants that settled in large urban areas. What we do know, Shelley, is that since the beginning of the year, our run rate for immigrants, permanent immigrants coming into Canada, is still positive. It's 17,000 a month, but we're well undershooting the normal target of 30,000 people a month. Still, we still have labor or working age population growing at 1.2% year over year in this country versus 0.6% in the US. Okay, that's important to keep in mind. And given that we still have some immigrants coming in, we have this increase in labor force that is still very, very supportive of the housing market. And as you can see on this slide here, believe it or not, but labor force in the GTA, so Greater Toronto area, is at an all-time high. It's the same thing for Greater Montreal. So you compare the three top metropolitan areas in Canada versus the three top metropolitan areas in the US, where there's been virtually no labor force growth for the past decade, then you understand the support that comes to the housing market from this immigration policy. So to answer your question, Shelley, we need, in my opinion, at least 200,000 immigrants a year going into 2021 because there are difficult labor market conditions to help support the resilience in the housing market. 90% of household formation depends on our immigration policy. I doubt that we'll be able to reach the 330,000 annual quota set by the government next year because of these difficult labor market conditions. But at 200,000, I still have resilience. So it's a slowdown, but still to this day supportive to the housing market.
I know it'll be interesting to see if the government plans to increase immigration targets, possibly to make up for its shortfall that it will have this year. I wanted to touch back on what Jean talked about earlier when he talked about the coordination between fiscal and monetary authorities that we've had globally during the pandemic. What are the costs and benefits of this coordination during this time? Is this something we're going to see moving forward?
Yeah, so I think we call that nothing short of a policy revolution. We've seen glimpses of some feature of this coordination that appeared in the post-financial crisis. But what we've seen over the course of a few weeks back in February is at a different order of magnitude. The coordination to us is a fait accompli. There is now in place facilities in the U.S. that requires joint decision between the fiscal authority, the Treasury, and the Fed. There was even debates with Republican proposal 10 days ago about cutting up some of the funding for some of these facilities to repurpose for other fiscal budgetary spending. So that speaks to now a much more politicized and blurring of distinction between the Fed or monetary policy and fiscal policy. And it's not only the U.S. We see that as a global phenomenon. In the UK, you've seen explicit talk of or even like framework of debt monetization being on the table. And we're seeing also, implicitly a move towards yield curve control globally. So that leads me to a couple of additional points. I think that clearly for us impact on the outlook, and it links back to the inflation discussion we had a bit earlier. We think the world that we're entering now is quite a bit different than the last 10 years. I agree with Beata that if you look over the last 10 years, you have to, why would you start to expect inflation now going forward? I mean, it's been missing in action. Central banks now are suggesting, the Fed in particular, that they want to overshoot their target. But I would have always liked to dunk at basketball, and the solution for dunking for me is not by raising the basket. So I think that's there's reason to be skeptical about the inflation outlook. But there are three things that are very different. One is we have cost pressure globally that are real. I mean, there's resilience as a team for global supply chain, deglobalization, sustainability. I think are all things that will contribute to higher costs of production. Central banks are tolerant of more inflation, so they might not be able to engineer it by themselves, but with the help of cost push pressure, they will be happily let inflation run above their target. And the third thing is that now this policy revolution, I think, will make it a lot harder politically to lean against inflation. So Beata was mentioning earlier that she doesn't expect debt burden to be a consideration in setting policy and preventing them from raising rates because the environment will be conducive to low rates. I agree with that. But the political calculus going forward for raising rates will be a lot more about the concrete debt servicing costs, both private and public, than it would be about the amorphous risk of inflation, because everybody thinks inflation is dead, as we've started the conversation. So all of that together, this policy revolution ultimately leads to us in a world where inflation will be easily, higher than it's been over the last 10 years. And, 3% doesn't look crazy on average over the next 5-10 years compared to the lower rates we've seen before.
So get ready for higher prices.
Somewhat higher. I mean, we're not calling about any hyperinflation or any 5 running away inflation, but 3% will feel very different for consumer and investors compared to what we've seen up to now.
In addition to the policy revolution, where we've seen the fiscal and monetary coordination, something else we've seen from the Bank of Canada is their kind of focus on income inequality, which is also a political issue. So do you feel, Stéfane, that this is an issue a central bank should be concerned about? And how does Canada fare on income inequality versus other countries?
I think they can talk about it, but they have to make sure they talk about it properly. I take issues with the latest speech from the central bank where they look at Canada, they say, we're just middle of the pack when it comes to income equality, and a lot of countries are doing better than we do. I want to show you this slide, and in my opinion, income equality is not a sufficient conditions to bring social cohesion to a country. It's also important to have social mobility. So the ability to attend all types of schools, to get into all types of jobs independently of where you're born and which neighborhood or which country you're born. And when you compare Canada to other countries on this slide, you'll notice, yeah, we might be middle of the pack in the OECD when it comes to income equality. But in terms of social mobility, we're much better than other countries. And this is staggering because there are no other countries in the world where 35% of the population is foreign born, and then they can still aspire to have job mobility, to make more than what their parents made, attend the same schools as others. And you can see on this chart, when it comes to income immobility, the US, the UK, Italy, they're not doing very well on that front. So that increases the tensions in terms of social cohesion and brings about more populism. I think from our side of the Atlantic in Canada, I think the key will be to say, how do we cope? How do we ensure that we still have this social mobility? And that goes into providing all these measures that can improve structurally, say, for example, the participation of women in the labor force, to make sure that labor market policies are flexible as they were prior to the pandemic. I think that is the key, Shelley, not just income equality, social mobility is key to make sure that you preserve this social cohesion. And we have done very well over the past decade.
During the pandemic, the federal government has unveiled a host of programs to help with people who have lost income, like CERB. And of course, they've been helping out businesses with the wage subsidy. So the government is running a pretty large deficit. So I'm curious, Jean, at what point would you be worried about the level of debt to GDP ratio?
Well, I've been involved in discussion not so long ago, but it looks like decades ago around what is the target level for debt to GDP ratios that we think should be aspiring. There were attempts to have G20 agreements on what that might look like. Those numbers look like, ridiculous now, given where we are. We're talking about debate about 60, 80%. That's completely irrelevant now. So it's very difficult to come up with, a number, and I don't think that's necessarily very useful. What I would say is two or three things. The first one is, dealing with this natural health disaster required, bold measure, and I don't think debt sustainability was any concern in the near term about framing how we should have been responding. So in that sense, I think it's a bit of a whatever it takes from the fiscal side that is needed. That's what the messaging was. Now a bit more question, as I said, in the U.S. about whether that's going to continue to provide that bridge, because the consequence of not providing that bridge would be potentially morphing into more of a balance sheet wave of balance sheet pressure and default, which would create a whole different set of issues, much bigger. So I don't think the debt or the deficit is really necessarily a concern that should frame the policy response in the near term. I do think, however, that I'm going back to my policy revolution. I do think it changes the way monetary policy and fiscal policy will be able to react. So I think there's no number where that sustainability becomes like magically a worry. But I think we'll feel the debt servicing costs both on the public and on the private sector side from any tightening of monetary policy. And that's going to become more real going forward. So I think the answer is not so much what the number is, but it's more the constraint it's going to be providing now on the policy landscape, to my mind.
And we may find out more this fall on their other spending measures in the fiscal update. But for our last question, of course, we have the upcoming U.S. election. So, Beata, what would it mean for Canada if Biden versus Trump wins?
Yeah, big question. So I think first it's always important to remember that the purse is controlled by Congress. So a Biden win with a split Senate and House means that puts a speed limit on what the president can do, and likewise for Trump. And so if you live in a world, let's presume that it's a Biden win across all three chambers, what could that mean for Canada, or at least where his policy lean is? Certainly the view is, Biden's plan is for far more progressivity in the taxes, and to unwind some of the corporate tax cuts that were put under Trump. And so from a Canadian perspective, that would help to level the playing field from a corporate tax perspective. Certainly Biden would be friendlier on international relations, and we wouldn't have random tariffs put on us with the frequency that's been happening, with the aluminum being the latest and then removed. But at the same time, let's remember Democrats in their platform tend to be tough on trade. So while he would have a more diplomatic approach to it, China would still very much remain in crosshairs, and there would be an element of pressure to remain tough on trade. So those are some of the positives, with the trade side being a bit more ambiguous. And then on the negative side for Canada, Biden is against the Keystone, and so while right now environmental and court action is holding that up, it would be dead on delivery under Biden, and that could be net negative for the Canadian dollar. They also have Buy American under the government procurement projects, which means Canadian companies that are currently feeding into the government procurement process could be cut out from that perspective. So again, I think Canadians have a natural lean towards Democrats based on our own government selection. However, it's not clear cut that a Democratic win will be all that net positive for Canada. It's going to be 6 of one, half a dozen of another in terms of what we end up seeing. So, and certainly, as Stéfane mentioned, how important immigration is to Canada. Well, we have been benefiting from very tough immigration laws in the US that has no doubt made Canada a top selection for countries around the world. And Biden would definitely be more open to immigration, as well as in particular skilled immigration. And so we would be competing against a much tougher market in the event that they do immigration reform on that front.
Can I chip in very quickly on two points, just to maybe emphasize two things in line with what Beata was saying. I think there are two key points to our analysis. One is the difference between a Biden sweep and a divided like Senate and Democrat is huge. I think it can amount to 5% of nominal GDP, in the two scenarios. So that's, I think it's important to focus on the difference between those two, even if it's Biden in both. It's a different world. And the second is, I think, the global push to sustainability in different form, but both from the regulations, but also the push that is already driving investors, I think will be supercharged in a Biden Democratic sweep. That would be another big difference.
You see Biden contributing more, you said, to the GDP?
So it's Biden in both cases, but Biden with a sweep, having both a Democratic House and Senate, would lead to a much bigger boost to GDP than if it's a divided Senate and Congress. And the difference is significant. Like we're talking about 5%, and then the implication for sustainability globally is also significant.
Stéfane, did you want to add anything?
Well, in the short term, I'm concerned about a contested election. So I think that from a market perspective would be the first hurdle, and then we'll see after that.
That concludes our discussion. Thank you to all of our panelists for joining us, and please stay tuned.
All right. Well, thank you, everyone, for joining today's panel. With me, I have Sun Life Senior Vice President and Head of Investor Relations, Lee Chalmers, La Capitale Executive Vice President and Finance Lead, Melissa Gilbert, and Intact Financial Chief Financial Officer, Louis Marcotte. Welcome, everyone. So we'll get right into it. I'd like to start with a broad question, but I know it's one that's on everyone's minds, and that's how has your firm managed throughout the early phase of the pandemic, and what do you see as some potentials for growth as we move past this acute phase? And I'd start with Lee on that one.
Great. Thanks, Kevin, and thanks for having me here today. It's obviously a pleasure to be here with both Louis and Melissa. So actually, as you said, I am the head of investor relations, but I'm also the head of capital. So certainly an interesting position to be in the middle of a pandemic. And I definitely have sort of that front row seat to really see how our business has responded during the pandemic. So I guess I would say, first of all, we've really demonstrated the resilience of our business. You know, we've now reported 2 quarters of earnings since the pandemic started. And we were fortunate in that we came into this pandemic with a strong balance sheet and a very strong capital position. And that, I guess, in addition to our balanced and diversified business mix, has really helped us weather that storm. So what I'll do, maybe just looking at the diversification of our business, in Q2, we did see some higher life insurance mortality claims coming through, but that was offset by favorable benefits in our UK annuity block. So again, really having a very minimal impact on our business. From a product perspective, our business is really mixed between life and health as well as asset management business. So as you know, with low interest rate environment, that's obviously going to have more of a headwind against our insurance business. But on the asset management side, our MFS pillar, we're really benefiting where investors are moving into higher yielding equity. So again, that diversification is paying off for us. And then lastly, I'd say on the geographic diversification, obviously this is a global pandemic impacting all of our businesses, but because we're seeing some countries coming out of it sooner, particularly in Asia, for example, our Q2 results, we saw that, our sales were really flat, Q2 current year over prior year. And that was really a function of China, Hong Kong, and Vietnam coming out much sooner and really offsetting the negative headwinds we were seeing in those countries that had those more severe lockdowns. So lots of diversification that has managed to help us remain resilient. And so maybe just quickly you asked about, sort of opportunities that we're seeing. I would say it's really about digitization of our business and moving to digital, being more agile. We started on that journey 5 years ago with rolling out technology to our advisors. And, that's really helped us stand up our business quickly and then continue to be out there selling. So that's a lot. That was a big question. So maybe I'll turn it over to the others to be able to jump in and add some comments.
Melissa, would you like to follow?
So hi, everyone. Very pleased to be here. So as mentioned, I'm Melissa Gibbard, the Executive Vice President of Finance for La Capitale in SSQ, because that's one thing that I wanted to mention. During that pandemic crisis, we actually completed the merger of SSQ La Capitale. So very proud of that. Even with 97% of our staff working from home, the merger was announced on January 29th, and we completed the merger on July 1st. So in the midst of all this pandemic situation, so very proud of that. In terms of the, I would say, financial situation of the company, we managed quite well. And that also allowed us to provided some relief to all our clients in auto insurance, so a 20% relief. And also, we also provided a 60% relief to all our clients for dental care in group insurance sector. So, so that was the part we did for our customer. And so that's about it.
Louis?
All right, thank you. Good morning, everyone. And so our beginning position was one of strength as well from an operational point of view and a balance sheet point of view. Primary focus at the outset of the pandemic was clearly safety and health of our employees, but as well making sure we had service levels adequate for the needs of our customers. And sending 97-98% of our staff at home and being able to maintain service levels was a key priority. The second phase was a bit absorbing the potential financial impact of the pandemic. I think in Q1 we took up the reserves we needed to cover any losses from the crisis, and at this point in time, a few months later, we feel very confident that what we've taken is sufficient to cover any potential costs. So I think we're in a good position here. From a forward-looking point of view, I think we came in a position of strength. And really, the goal we put for ourselves throughout the crisis was maintaining that strength, because we knew that at further down the line in time, either we'd see more shocks, and we wanted to be in a position to absorb those shocks, or alternatively, should there be some opportunities for growth, we'd be in a position to capture those opportunities. So clearly, there's a view that the pandemic will bring a bit of dislocation in the industry. Consolidation will take place. Will continue to take place, and we want to be in a position of strength to be able to capture those opportunities, and we are. So we feel in a good position right now.
All right, Well, thank you. And so obviously the pandemic is still not over, and there's not a great deal of certainty of when actually that might be. So what would you say are the biggest risk or two that's still facing your company in the midst of this pandemic? And we'll start with Louis on that one.
Sure, thank you. So as I said, I think from a reserving point of view, we're at the right level. We've got what we need, and at this point in time, given the observations we see, the risk remains very, very limited. Well, of course, what can happen to us right now is what we call indirect losses, and those would be derived from the prolonged economic slump that we're facing and that we might be facing going forward, and that's not factored in. Wave two and prolonged economic downturn would be something that would put a bit of pressure. We think we're in good position, but that's one element we're currently watching for. Some coverages, for example, in some of our businesses in surety would be one that would be potentially most impacted, and we're carefully monitoring what's going on that front. Of course, activity on capital markets, the fluctuations might be important, and there's a bit of uncertainty going forward. So we're prepared for that. We've really put our balance sheet in good position to capture those risks if they come around. Natural disasters remain a risk for us. Although we're well reinsured, you never know what can happen. It's been a fairly quiet year so far, but they remain a potential risk. And the last one I would talk to is there's a lot of talk around business interruption in our sector. And I would say here we feel very confident that the level of exposure we're facing on that front is extremely limited. And there's a lot of noise, but at the end, our level of fear on that front is quite limited. So those will probably cover the major risks we think about on a regular basis right now.
All right. And Melissa, how about for La Capitale?
Well, obviously, we are very careful about all the risks that are in front of us, especially in that pandemic crisis situation. But I would say the biggest one we're definitely looking at is the uncertain economic environment right now and how it will affect all the companies and households, so all our customers. And obviously, so that's something we're definitely looking at right now.
Sure. I guess what I would say is that, similar to what Melissa and Louis have said, it's really about how long and to the extent we're going to see this pandemic impacting us. So both from a market perspective and economic impact, and what that means not only to our business, but our clients. So certainly market volatility, we did see the markets, very volatile in the first period of this pandemic. We've seen those stabilize. So obviously, to the extent we see more volatility, it certainly will impact us from our assets under management and our fee-based business. But again, that diversification, I think, helps us. And then, again, I mentioned it before, but the low for longer interest rates. We've been in this low interest rate environment for a while now, and a declining interest rate. So as a result, we've demonstrated our products can be adjusted. We repriced in our Canadian individual business in April. So we will continue to look at that. But again, when you look at our business, we like to talk about it as being 20, 40, 40. So 20% of our business is really at risk to those lower interest rate environment, whereas 40% is our asset management business or our group business, less tied to those longer term interest rates. So with those, our ability to adjust our pricing and our products, as well as being less concentrated in low interest rate environment risks, we think we're well positioned despite this headwind.
Thank you. And you mentioned lower interest rates. Obviously, that's been one thing that's shifted a lot in markets during this pandemic. There's been a lot of other shifts in markets. I'm curious to see how have your firms been making changes in your investment portfolios. I guess we'd start with Melissa on that one.
Well, we started with a very strong position, so that definitely helped. Also the asset liability management drives our investment strategy. So obviously we were quite conservative, so the impact wasn't that high on our results. And I would have to say also, obviously, we have been very careful about all the liquidity ratio at the beginning, and we made some small changes in the investment portfolio, but nothing, I would say, significant. And I would say, obviously, I think for the interest rates, definitely we're thinking on a long-term basis the way we will manage the portfolio, because obviously this will affect especially the life insurance sector business. So really, we're thinking about how we can get the return on investment that we're looking for with such low interest rates. So,
Lee?
Yeah, so again, quite consistent. I mean, how I'd probably answer that is really looking at two aspects of our business. So first on our general account assets and how we've adapted there, but also in terms of our business we call SLC management, which is about our alternative asset manager. So on our general account, obviously nobody predicted this pandemic, but it's certainly something, we knew we were certainly long in that credit cycle. I think of all the meetings I attended where we were in the 9th inning, the 10th inning, I think it was the 14th inning of the credit cycle. So everyone anticipated something was coming. And as a result, we really started to reposition our balance sheet. So, we upped our quality on our commercial mortgage book from BBB to A. We, fundamentally repositioned our real estate portfolio, moving away from, indoor malls to more outdoor malls, grocery anchored, reduced our exposure in Alberta and oil and gas. So we really came into this pandemic positioned well, and also in a position where we had highly liquid assets that, as we saw the spreads blow out like we did early on in the pandemic, we were really able to take advantage of the opportunity to buy up additional assets at, high quality but higher returns. So certainly we were in a good position as we came into that pandemic. And then the second part I wanted to highlight was just around our asset management at SLC and our alternative asset management business. So this is a business we started 6 years ago, and it was about the need to look and provide our clients with alternative asset solutions. The interest rate, as I said, we were operating in a declining interest rate environment. We knew there was a search for yield. So we built up this business from, zero to over $100 billion today. And, fundamentally, in that portfolio, we have real estate, which was, we bought Bentall Kennedy. We expanded that a year ago with the acquisition of Green Oak. And then just recently this year in July, we announced the acquisition of Infrared Capital, which is about infrastructure investing. So again, really positioning ourselves well to take advantage of, the lower interest rates and investors looking for higher yielding returns.
And Louis?
Sure. So we came into the crisis with a portfolio that had about 24% equities between common equities and preferred shares. Of course, it was a bit tough during Q1, but we took the decision to reduce that portfolio, sold some of our international exposures, and actually in Q2, we hedged some of the equity exposure such that today our common equity went from 14 to 10% roughly of total invested assets. So we've reduced that position. It's de-risked it a bit. And at this point, have not chosen to rebalance our asset mix, which is below our usual target. So we remain cautious because we're sort of uncertain of what's going to happen in the future quarters. As we said before, should the crisis prolong and the economic slump continues. So we're quite careful. On yields, of course, that's putting a bit of pressure on the operating earnings. So we're monitoring this carefully and reinvesting at a slow pace. Our portfolio turns over 6 or 7 years, so it doesn't change abruptly, but it does put a bit of pressure. But fortunately, with 1-year policies, we're able to reprice on the underwriting side, and as we do for ROE to maintain our ROE target, we're able to reprice every year and offset some of that pressure. So we feel in good shape here, even if yields are declining, to maintain a mid-teens ROE level as we have in the past.
All right, thank you. Well, I'd like to finish with one that's maybe not, strictly, business and financial related, but the pandemic has changed a lot about how people behave, how consumers behave, how just society functions. And I wanted to get your thoughts on what do you think might be one or two big changes that persist even after the pandemic has subsided. We'll start with Louis on that one.
Sure. I think one change clearly is the digital adoption. We've seen a sharp rise, and it's clear if people have to stay home, that's a big shift. And we're seeing much higher take-up rates than we have in the past. So I don't think that will change. I think it's just going to accelerate. And the other one, of course, is working from home. I think most companies have shown the ability to get people working from home. It's working well. I'm not suggesting it's perfect, but I think it's a change that's happened now, and it's proven to work. So we have to adjust for that, and then finding the right way to balance this notion of working from home, but yet keeping company culture, training of people, onboarding people, which, in a 3 or 6 months time space, it's not maybe bad, but over long term, it might be more of a challenge. So we're trying to wade that through, but adjusting to the fact that the new reality, which is a lot more work from home than in the past.
Okay. Melissa?
Yeah, well, I totally agree with Louis. I think the two major ones are definitely digitalization. I think it was already starting, prior to the pandemic in all the insurance industry, but obviously I think it accelerates the digitalization and also the way we distribute insurance. So obviously I think if we want to reach the client that are at home, we need to move forward in that path. So, and the second one, obviously, it's the workforce management. I think working from home, but also it will change the way we recruit people, because even though we were open to recruit, I would say anywhere else, I think it get it to another dimension that we can definitely work. And even if we're not locally together, I think we definitely, I would say, we definitely stepped up in the way we are working with others and get closer, even if we're not in the same office, if we're not in the same city. So I think it will change the way we work together and also how we attract new talents as well.
And Lee?
Yeah, I was going to say, I think I have the same notes as the other two have. So I guess I have the exact same point, digital and digital transformation, and obviously our work from home. And I guess maybe all I would add on those 2 points is I really do think it's a real opportunity to build relationships, whether it's with our clients or whether it's internally with our people. We were sort of talking before we started this session about how, yes, you're not face-to-face, you're not connecting in the office, but in some respects, you're getting closer to your employees and getting to know them better, their kids, their dogs, you're coming to get to know sort of their environment. So that, I think, has been a positive, and I think that will continue to change. And then I think on the client side, clients are adopting the tools certainly out of necessity, but I think they're also going to start to learn to see it as being an opportunity to how they can connect more virtually with their advisors. And just one anecdote, in our U.S. business, the immediately once the pandemic hit in March, we were holding virtual sessions with our clients, employees, and our group benefit plans on one call. We reached over 14,000 employees. So people are engaged, and we're creating and providing those tools to stay connected with our clients. So I think that'll be a real upside of this pandemic and as we go forward.
All right. Well, that is all the time we have today. Thank you very much, everyone, for joining us.
Thank you.
Thank you.
Thanks for having us.
Thanks very much, Kevin. And I'm Derek DeCluet. I'm the Canada Managing Editor for Bloomberg, and it is my great pleasure to introduce 4 experienced portfolio managers who are experts in fixed income. We apologize for any earlier audio issues we had on an earlier panel. This panel is going to be great, and it begins with Jeff Marshall. He's head of fixed income at CI Financial Signature Global Asset Management. From somewhere in the state of New York, we've got Scott DiMaggio. He's co-head of fixed income and director of global fixed income at AllianceBernstein. Diane Young has joined us. She's a senior portfolio manager of fixed income and co-head of corporate bonds for Addenda Capital. And we have David Wolf, portfolio manager and all-around asset allocation guy at Fidelity, formerly of the Bank of Canada. Welcome to all of you.
Thank you.
And thanks Thanks very much for joining us. And I'd like to start with a really big picture question, because we've had huge changes in the macro environment over the past 8 months. Central banks do not have a lot of policy room left. Interest rates very low, probably for a very long time. Wondering if each of you could walk us through how that affects how you approach or think about the various markets that you invest in. And David, we'll start with you.
So thanks, Derek, and thanks everybody for having me. Why don't I start off just by saying, it pains me as a former central banker to say this, but I think the monetary policy regime we've gotten used to in recent decades is effectively over. It's hard for me to imagine that central bankers are going to be able to lift rates off of zero anytime, frankly, on the visible horizon, given where the economy is and likely to be, and given the ballooning of debt from levels that were already quite high. So it's a world where rates need to remain very low for very long. It's a world where central banks, I think, go back to what they used to be, which is effectively making sure markets are functioning, acting as lender of last resort, and frankly, being the government's banker. So, in that world, and I'm an asset allocator, so I run multi-asset funds, so we have a wider playground than just in fixed income. When I think of the relative attractiveness of different asset classes, nominal government and high-grade corporate bonds fall pretty far down the list. They don't yield much. They don't provide much cushion against risky asset downdrafts. And they are vulnerable to inflation, which, frankly, I think is probably an inevitable outcome of this, though it may be well down the line. So we're basically reducing our holdings of those nominal government and high-grade corporate bonds in favor of more real assets that we think can provide a bit more protection and diversification in the environment we're likely to have. So that's things like real return bonds here in Canada, U.S. tips, and a fair bit of gold, too.
How about you, Scott? What do you think of that?
I couldn't agree more with what David said, and I'm glad I'm not a former central banker, so I'm not in that camp. I think if you listen to Powell and you listen for the past few days, you listen to Lagarde in Europe, over the past few months, the central bankers have been begging, right, for fiscal stimulus. They know that the efficacy of monetary policy is touching upon what David said. It is going to be a really important theme for us and for markets over the next couple of years, this joined at the hip theme, right, where central banks are going to have to keep rates pinned at these ultra low levels so that governments can finance themselves and the cost of servicing that debt does not rise. So I think the central banks will support interest rates. So while it's hard to see rates rallying a lot from here, I think it's also difficult to see them selling off over the next 12 months in any meaningful fashion. I would say as a fixed income person, we still find value in the credit markets. We've had a tremendous run from the depths of March in recovery and credit spreads. The one solace that we take with valuations where they are is that we still have a tremendous amount of buying power, whether it be from the BOC, from the Fed, from the ECB, that will continue to support the credit markets, whether it be some securitized markets, the provincial markets, or the investment grade and high yield markets. So while the valuations are not where they were or not as attractive as they were 6 months ago, we still find value in that part of the market.
Diane, how about you?
Yeah, I would agree with everything that's been said. I would say we, unlike David, we I operate in a fairly limited environment, pretty much Canadian fixed income, and so although those high grade investment grade corporate bonds that fall down the list for him actually fall pretty high on the list for us. I mean, we still see value in spread product with government rates so low. Even provincials still offer a lot of extra yield relative to how low our Canada bonds are trading. We also still see value in long duration assets, as much as we've said for many, many years that rates can't go lower. Not really in the camp, but rates can go lower if you believe that zero isn't the lower bound. And with that would probably come a flatter yield curve. So with still roughly 100 basis points of yield curve in Canada and roughly the same, little more in the US, I would still say there's value in long-term government bonds.
Jeff, where do you stand?
Sure. So all good points that have been made. I'd say, unconventional monetary policy is now conventional. I would characterize this environment as, pre-yield curve control, where we can expect, government bond yields throughout the curve to be very range bound and probably negative on a real basis. And so I think I ask myself, what does that mean for portfolio construction? I think investors are going to have to take more risk, whether it's more duration risk, credit risk, liquidity risk, foreign exchange risk. Probably have to expect more volatility out of various other asset classes, less of diversification benefit of fixed income. Expectations are going to have to come down, and I think you're going to have to get creative. I think you're going to have to get creative on a fixed income basis. Looking at gold as a diversifier, U.S. dollars to a Canadian investor, and I put it out there. Eventually, longer term, even Chinese bonds, because that's kind of the last rate structure that can really collapse and generate the gains that would offset, credit or equity losses. So we're going to have to get creative.
Since this is the Canada Fixed Income Conference, we'll turn our attention home for a second. And there's a great deal of talk about fiscal policy right now, especially, as you say, monetary policy is becoming a bit limited and what more it can do. We had a big throne speech yesterday without a lot of numbers, but with a lot of ambition. How much do you guys, as investors in Canada, think about the big picture fiscal question coming out of Ottawa and the provinces? And does it really matter that we're having this debt spree? Diane, why don't you take that one to start?
Sure. So as you said, we did have the throne speech yesterday, and I think the theme there was there's something for everyone. Definitely left-leaning and lots of ambition, as you said, for lack of austerity. I would say lots of spending expected, and certainly becomes very political when you talk about a government that's operating in a minority. So there does need to be some support. I guess our thought is that there will be. And does it matter in the short term? I mean, take your pick. Every developed nation out there is spending and will continue to. The U.S. certainly fighting with the election in the meantime, but the spending will continue. And as much as our monetary policy experts have agreed, it does need to come from the fiscal side. So we would expect that it will continue. The biggest question is what does that mean going forward? And of course, what we think is that it just limits growth down the road. I mean, when you take on the massive amount of debt that developed nations have been and continue to, it's not as productive. It's not like private debt. It just doesn't generate the kind of growth that we're going to require. So it just adds further pressure, downward pressure on inflation and on growth going forward. I mean, the middle class is going to bear the brunt of it in Canada, as much as the big comment was that's who the government is trying to support. That's exactly who's going to pay for it in the form of higher taxes later on.
How's our former central banker feel about it, David?
Well, I'll take, I guess, a slightly different tack than Diane did. I think it very much does matter, this aggressive spending and borrowing and effective monetization that we're seeing, but it also matters in a relative sense in Canada versus other countries. So, one can say, yeah, everybody's doing it, so it doesn't make a difference. Canada is in a more challenging position than most countries if you look at either the level or trajectory of debt. To give you a quick statistic, so if you take total economy debt in Canada, so gross and all sectors, so all levels of government, household, corporate, et cetera, that number was about 250% of GDP in the early 90s when we got downgraded, et cetera. It was 350% of GDP at the end of last year. It's now 450% of GDP. So, you tacked on a year's worth of output in debt in 27 years, then you did it again in 6 months. And that debt level is higher than, I think, pretty much every G20 country except Japan and possibly France. So I'd have to look at the Q2 data. But the point is that everybody is doing this, but we have, I think, greater challenges in terms of sustaining this fiscal trajectory than most. And one of the interesting bank shots of that from a market point of view is there's actually a very interesting leading relationship between the relative indebtedness of Canada versus the US and the relative exchange rate of Canada versus the US. And so I think that higher weight of debt, to Diane's point about that retarding growth in the future and generally being a headwind for the economy, may express itself to some degree in the exchange rate as far as Canadian dollar depreciation.
I see Jeff nodding a bit here, so why don't you take it, Jeff?
Yeah, I'd say that's a fair comment. I think, a lot of this is going to come down to currency depreciation as a lever that central bankers would like to pull. And I'm thinking, last week, Christine Lagarde at the ECB was very cautious on speaking to the strength of the euro. I think cognizant that you don't want to get into a currency war, with your neighbors and your trading partners and particularly the Trump administration. But, I think currency is going to be part of it. Canada, I think, lacks a certain degree of monetary policy independence from the Fed. And doesn't have that reserve currency strength that the U.S. has in terms of being able to run higher deficits and higher debt levels. And we've got a lot on our plate. We've got to bridge the economy through COVID. We've got to. This seems like it's an agenda item to address income inequality and climate, and that all translates into, I believe, higher marginal tax rates, which in itself is going to impede growth. So there's some short-term and some long-term challenges here, which I don't necessarily see ending well. But again, it's relative.
For those who know their history in Canada, we were certainly reminded about that lack of reserve currency point in the 1990s when we had some trouble. Scott, you want to take this one as well?
Yeah, I'll just make a few comments. I'm in that if you're not going to spend now, when is the time to spend? So I do think fiscal is the only game in town right now. If that money is used for productive purposes, which we can all smirk at because chances are a lot of it will not be, right? That will be a bit of a waste. It will lead to lower growth in the future, higher taxes. Agree with all of that. I think the one point I would take a disagreement on is if you look at Japan. I mean, Japan has kind of kept this game going with massive fiscal deficits in a low inflationary environment by increasing the size of the central bank balance sheet. I don't think there's any reason why Canada, the US, Europe cannot go down that path for the next several years. Eventually, the day of reckoning will come, whether it be in the form of a currency crisis or runaway inflation. But I think for the next 24 months, this has to be the path that central banks and governments follow.
I'm going to ask you guys about inflation in a sec, but before I do, first of all, I'd like to remind the audience that you have an opportunity to submit questions. We would love your questions. There's a function on the right-hand side of your screen. And before I get to inflation, I want to ask about provincial debt because Canada has a somewhat unique feature in having a lot of responsibility and actually quite a lot of debt at that subnational level. Diane, you mentioned it in your opening remarks that you kind of like some of the spreads. Can you just talk a little bit, if you would, about what you see in the provincial market where some of the opportunities might be?
Yeah, I think, you kind of have to know the Canadian provincial market to understand there's a bit of the haves and the have-nots. And certainly Ontario, BC, and Quebec tend to be the largest and the most liquid provinces, the ones that are able to fund themselves internationally. Alberta obviously facing some pretty unique challenges right now with the energy market. And certainly their valuations have reflected that, as have their deficits. I think that there is value in essentially a quasi-sovereign type of an issuer, which is relatively how they're seen. However, to David's point, I mean, there is a lot of debt being taken on by these provinces. A lot of, that is going to have to be funded later on, and they all have their unique sets of challenges. So as much as I say, there's valuation there, it's not to say if the international markets or the international audience that has been a large contributor to funding these provinces were to take a back seat, I think that you would see spreads widen and you would see, rates higher, that it would just be more difficult for them to fund themselves at an attractive level. So that would be one concern. It certainly hasn't been an issue. And again, to the point made earlier, with the central banks essentially backing the provincial debt market, much like they have the corporate market, it certainly has been a very, efficient kind of way that they can fund themselves for now. If we talk about 2-3 years down the road, perhaps it could be more of, to David's point, they could be more into a problem running themselves with such high deficits.
Anybody else want to take that on, the question of provincial finances and value or not in provincial debt?
I think I would add to Derek. I think I would add to Diane's comments. Decent carry. A certain degree of gap risk outside of, or even within, the big four: Ontario, BC, Alberta, Quebec, where points in time like March where it's hard to get a bid on paper. And if we're going to take that illiquidity risk, we've been increasingly focused on the municipalities where we're actually seeing, better credit quality, smaller issuers, but limits on deficit spending, for example, and fiscal support from provincials, the provinces, and the federal government. So better credit quality, but we're taking some liquidity risk. So we're finding decent carry there.
So I'm happy to chip in. Yeah, sorry.
Please do. Yeah.
So this is, partly in answer to the provincial question, but also getting back to Scott's comments, which I think are critically important. So, the trajectory, whether it be of provincial debt, broader federal debt, whether you're talking about Canada or the rest of the world, I think one of the critical questions for our time is Japan unique? In the sense that, as Scott said, Japan has been running these massive deficits and gross debt levels for years without, the economy obviously hasn't been very good, but you haven't had runaway inflation, you haven't had market stress associated with that. And so, is Japan unique? Is there something about the Japanese economy and, it's more internal focus in terms of the owners of that debt that make it unique? Is it unique because Japan was basically the only country doing this for many years, and now every country is doing it? And we don't know the answers to that, but I think that's sort of the question for our time that's relevant not only to Canada, but really around the world.
Yeah, it's a huge one, and I guess it's a good segue into a question about inflation. So forget the short term, but if we're thinking of a more medium term time horizon, over the next, say, 5 to 10 years, could each of you sort of give me what your thoughts are on the potential inflation dynamics? And Scott, we'll start with you.
Yeah, I would think that our view is inflation is definitely on the upward trajectory, and that we've kind of left the deflationary world that we've been in for the past 10 or 15 years. I think that is really dependent upon monetary and fiscal acting in unison and continuing to step on the gas. When I think about the debt that we have, the easiest way to deal with the debt burdens, right? Look at the way we dealt with them after World War II, was really via financial repression, right? Try to generate nominal GDP that is significantly above the cost of financing that debt, and over a decade or several decades, right, eventually pay down, that amount of debt. So I think inflation. I think if central bankers, whether it be and fiscal authorities, whether it be through something like MMT, if they're committed, they can generate inflation. And I think much like the 50s and the 60s, they have to generate that inflation to deal with the debt burdens.
David.
Yeah, I fully agree with Scott here. I mean, a former colleague of mine used to say, there are 3 ways out from under a debt burden. You can grow your way out, you can default your way out, or you can inflate your way out. Growing your way out doesn't look very likely in this world. Defaulting your way out is never necessary for a country that issues its own currency. And so inflation is kind of the path of least resistance. And, whether you come at it, as a modern monetary theory type of person or with a more kind of, classical macroeconomic framework, or you look at the political economy of it, the fact of the matter is there's no barrier to monetary and fiscal policy, as Scott said, working in unison until they find where that inflation constraint is. And eventually they're going to find it. And I don't know if it's a year, 3 years, 5 years, 6 months, what have you from now. But to me, this is pretty much inevitably the place that it ends up. And inflation protection, to my earlier point, is still relatively cheap. It's one of the reasons we're buyers of it.
Diane.
Yeah, I guess we have a little bit of a different view that we just certainly in the next 2 to 3 years don't see really any inflation. I mean, typically you need a lot of credit growth and things like that to spur inflation, and we're just not seeing that. As well as if we look at history, I mean, I have no argument that the monetary authorities will try to spur inflation. That is absolutely their goal and their wish. But we've been hearing that for 20 years back in the Bernanke days. So I think they will do everything they can. And I think we're getting maybe we get some false starts. But I think even when you listen to Powell, I think even they've a bit resigned themselves to saying they're hoping for it, but I just don't. The large output gaps that we're seeing and the amount of fiscal stimulus that really is just keeping us afloat right now eventually will be weaned off. We don't see it in the next, say 2 to 3 years.
Any dissent, Jeff?
Diane, give me a call if you want to sell your ribbies later on today.
You just made a trade.
No dissent on my point. I would say, look, I think there's a political element. All good points made, but there's a political element where, if we have now started down this road of deglobalization, whether it's a political issue or a COVID and redundant supply chain issue, but I think deglobalization raises, the cost of goods, and that where we've been in, a 40-year secular trend of globalization. Technology is part of this, and I don't think that technology element in terms of lowering prices and costs goes away. I'm just not convinced that deglobalization is enough to get inflation sustainably above 2%. Past 3, 4 or 5 years from now. So I agree. Inflation is needed to deal with this debt burden. I'm just not sure if we get it. And so further down the road, I think there will be some sort of great reckoning.
We're going to turn our attention to the corporate market now, and I had a good question from the audience. There's been huge issuance really around the world this year. Lately in Canada, we've even seen issuance for really hard hit by COVID sectors, airports, long-term care homes, and so on. Like each of you to kind of assess where there might still be value or opportunity in the Canadian corporate market. And Diane, maybe I'll throw that one to you as a starting point.
Sure. Thanks, Derek. And as you mentioned, we have seen record supply in the corporate market, investment grade corporate market this year. Certainly in Canada, we've had a bit of a tale of two cities where you've got the haves and the have-nots, communications, telco, most of the financials doing great. And then you've got the energy and the real estate sector. So that's kind of how we have divided it up. When we talk about areas of value, we still do see value in the REIT sector. The good old Canadian corporate market tends to be pretty illiquid, and these tend to be pretty small issuers. So new issue game is certainly alive and well, and I would say that demand we would expect to continue just with the yields there. The other area is still energy, depending on your view on oil prices. Even if they stay here, I mean, in the Canadian market, we're talking mainly midstream and pipeline issuers, so not really direct commodity exposure. We would still see some value there. As far as trouble spots, it's hard to see defaults in the Canadian investment grade market. We wouldn't really see those really materially rising. That being said, the Bank of Canada has been pretty clear in providing liquidity to the Canadian market. On the corporate side, however, they can't downgrades as much. So we would still see probably some rating migration risk. But as far as outright defaults, we wouldn't really have much of a concern in the investment grade market.
Scott, you've got a pretty good view of how Canada fits into the global corporate picture. What do you think?
Yeah, for us, I think there's value in in banks down in cap structure, especially playing in some of the AT1 deals. That's a kind of newer instrument to the market, but is a fairly well accepted instrument globally. So there's concerns in Canadian banks about the high exposure to real estate and to housing loans. A lot of those loans are insured. But we know the Canadian banks are going to have to take more loss provisions over the next 6 to 12 months. They've started to do that, but that number will probably increase. Despite all that, we still view the banks as in good shape, and we find value in the sub-debt of the Canadian banks.
Jeff?
Yeah, those limited recourse capital notes, I think, are interesting value to us. You know, if they make up 75 basis points of the bank's risk-weighted capital assets, I think that is, another $14 billion of issuance from here. That should take out about $9.5–10 billion of bank prefs, which are mostly a retail product. So this is one place I think that we actually see net issuance, bond debt taking out retail held pref debt. But I see, I think generally what we're seeing is a lot of issuance, a lot of gross issuance, but not a lot of net issuance. And we've got a spectrum auction coming up, which will probably be, there'll be a debt funded element there, but not a lot of capital projects being undertaken in Canada that would then need to be debt funded. So I'm not too bullish on net supply from here. Ongoing issuance for sure, and but not a lot of net issuance. Where we're seeing value, so those long limited capital recourse notes in the energy space as well as and the midstreamers like TRAP, like Enbridge, especially in some of their subordinated debt or hybrids, structures that have where there's a capital treatment incentive for those bonds to come out, earlier than their 60 or 70 year, final maturity.
David, how about you?
Yeah, just quickly, I'm less involved with the security selection specifically in terms of our portfolios. So as a top-level asset allocator, as our Canadian bond team, that really makes those security calls and sector calls. What I will say, though, a little bit bigger picture is to Jeff and Scott's earlier points about the attractiveness of credit and the need to be creative. I think there's a lot of value to thinking outside the box, so to speak, with respect to different sectors and different availabilities of spread from a credit point of view, both inside of Canada and outside of Canada. And that's both to generate return, which obviously is pretty meager on the index, governments, investment grades, what have you, but also as diversification. I mean, the way that I think about it as a multi-asset manager, in a 60-40 construct, the 40 used to be pretty easy, and it's not nearly as easy anymore. And so it sort of enhances the value of being able to sector and security select your way through your fixed income portfolio in order to not only add the income, but provide the diversification that folks like us are looking for.
An argument for active management. We've got only a couple minutes left, so in about 45 seconds or so for each of you, can you talk about a big theme, or perhaps even a surprise that you think could potentially shake up markets in the next 12 months? Your crystal ball, and Jeff, we'll start with you.
Yeah, so I don't want to go with the obvious one, which would be the U.S. election or even the Canadian election, but I would go with a theme of greed returns. And I thought after March, we'd see a little bit more fear, which accrues to the benefit of bondholders, right? We get management teams focused on deleveraging. I thought that would come back. I'm not convinced yet. I think in this low rate environment, we could see more debt financed share repurchases and the return of greed, which would be to our detriment as bondholders.
Scott.
Yeah, I'm going to take the easy one then, Jeff. I'm going to take what's a high impact, low probability event? What about a U.S. Arab Spring, right? That we do get a contested election, which is a fairly high probability. We do not have that peaceful transition in power. The Supreme Court battle that's just kind of started, does that start to lose legitimacy because one side either picks a candidate or the other side, stacks the court? Do we get to the point where there is that social unrest, troops in the street? I think that is a very kind of high impact, but low probability event for next year.
extraordinary that we're talking about that sort of scenario. David.
So I'm just going to say ditto with respect to Scott's comment, and I hope you're right that it's a low probability type event. I'm not convinced of that, but in terms of a clear and present danger to markets, that's an identifiable risk that we're certainly spending a lot of time concerned about.
Diane, the final word goes to you.
Yeah, I'll just quickly say, because I can't disagree on the election front, that's certainly the most up and coming. But I would just say, the continued pain trade, rates keep falling. I think it's what, few people expect. And I think it's probably the one that could hurt the most.
All right. Diane Young, David Wolf, Scott DiMaggio, Jeff Marshall, really appreciate you joining us today. And thank you so much.
I'm Amanda Lang with Bloomberg News, and we are with Evan Siddall, CEO of the Canada Mortgage and Housing Corporation. And Evan, it's great to have you with me. And I feel as though this is actually a particularly important time to have this conversation because there is so much uncertainty. So you get the fun job of trying to talk through all of those unknowns. But one of the biggest questions, and it's true everywhere you are, is what will happen to house prices. It's been a real uncertainty in Canada, and I know you've got a view, and it differs with some others, and it differs with what the market's saying right now. So what's your current view of what will happen to this market?
Our view, Amanda, hasn't changed. It's that the combination of economic adjustment that has to happen, the number of people on income support, the number of mortgages under deferral mean that at some point, probably early next year, through the middle part of next year, there will likely be a negative adjustment in house prices.
And quantify what that might look like. I mean, a negative adjustment, we were at pretty lofty levels in some parts of this country. So how much of an adjustment should we expect?
Yeah, that's hard to tell. And it's path dependent because in part it depends on how the virus itself manifests again. What industries are affected. Of course, oil producing regions are affected by geopolitics in that area. And some markets got farther ahead than others. So in general, though, we think high single digit negative adjustment is probably what we can expect in most markets. And, we said in the early part of this pandemic, 9 to 18%. And 9 was, we think everything's going to be reasonable. We're still in that territory, whether it's 8, 9, 7, doesn't really matter, that order of magnitude. 18 was very much a this could be really bad kind of scenario, which doesn't seem to be panning out right now.
And just let's stick with that thought process for a second. What would take us to 18 in your scenario building? What's the worst case scenario predicated on?
Well, that was back in March. So I don't think this is very much a path dependent forecast. That was the pandemic was going to be horrible, deep, and it's been pretty bad. But it hasn't, government income support and government fiscal support, government monetary policy support have helped alleviate some of those pressures.
Which actually is an interesting problem that we all have right now with forecasts, which is there's an awful lot of government support. And there is this sense that it's delaying some inevitable consequences, jobs that are already lost, but we haven't seen them, the layoffs happen yet, and the like. Yeah. Bankruptcies that have yet to really be noted. How do you think that plays out? Again, I know there's an awful lot of uncertainty in how that might look, but as government stimulus is withdrawn, what does that do?
Well, ultimately what it does is it requires economic adjustment. And in some businesses, there will be unemployment that results. And unemployment is the kind of thing that drives house prices lower. Governments, though, we're involved in policymaking in a number of different programs, including the commercial rent support program. And governments are deliberately, I think, in Canada, overreaching and creating more of a cushion than they otherwise would, because that's what governments should do. And that means that we will defer an economic adjustment, but it also means we're going to save businesses that have a shot at surviving. And that's I think that's the right calculus.
You and I have been talking about Canada's housing indebtedness as a problem long before the COVID-19 pandemic came along and created a whole different kind of situation. What's the lens on where that stands? And it's been an interesting picture because for some people, the savings rate has actually gone up, as we know, through all of this. What's your level of concern about household debt right now?
It's only higher. It's only higher because some of these deferred mortgages will not be repaid, and levels of household debt have gone up because people have deferred their mortgages. The debt to income level is artificially low because of income support measures that the government's provide, in particular CERB and broadened EI. And that's good policy, but it makes the savings rate look like it's going up when it's really just the CERB and people spending differently right now because we're in a lockdown economy or going back into one, perhaps.
And so in that context, what's your sense of the right kind of policy adjustment as we move forward here that would keep any kind of shock from happening?
Well, people hate me for this, people dislike me for this, but the stress test is having its desired effect. Bank of Canada is issuing monetary stimulus so that people who have decent levels of household income, not too high, might borrow a little more and buy a car, might borrow a little more and buy a fridge. Highly indebted people above 4 times income should be much more restrained because they may end up having negative equity in their homes. And the stress test actually helps restrain that lending to over-leveraged people. And that goes hand in hand with good monetary policy.
So would you say that because a number of changes were implemented, again, before COVID, but maybe fortuitously, setting us up for maybe a slightly more stable environment, you implemented a number of policy changes designed to, I don't know if you like the terminology, cool the market, but certainly kind of cool heads anyway, make people realize that low rates don't always last forever and that, the banks actually need to kind of be a little bit more mindful and putting words in your mouth here, but about the indebtedness situation overall. How much did that have a mitigating effect on what might come now? How much did that set us up better for where we are today?
Yeah, it's important. What we were doing there is we were signaling to people that we have a responsibility as a government entity not to jeopardize the economy. And high levels of debt create future drag on an economy. We were not telling banks they couldn't do this lending. That's for the Department of Finance. And we knew that our commercial competitors might take up the slack. That's okay too. They've taken up the slack. We were just saying we can't countenance that kind of behavior, that kind of we shouldn't be using taxpayer money to support high levels of indebtedness. And you're on your own. And that's all we were saying. And we knew the business would go away from us. We were asking them, please not to penalize us further because we were doing something we thought was in the best interest of the Canadian economy. So it really, Amanda, wasn't meant to cool off the market. It was more us being conscious of our role as a Crown corporation.
We did see the business move away from you, some of it. Presumably there is some mortgage origination that never happens as a result of these changes, but we saw that private part of the market grow. Are you at all concerned with the share that it holds today versus, 3-4 years ago?
That the private have?
Yeah.
Private share? No. In fact, I thought CMHC was too much of a market leader. And we deliberately said we wanted to de-risk CMHC and have private insurers take up the share. And that's exactly what's happened. And I think that makes for a competitive environment for lenders and for mortgagees.
I guess I would put it another way. I understand that you did not want to be the dominant player, and especially because, of course, that puts theoretically, that puts taxpayers as the last backstop. The private players, of course, may have different lending standards. They may be all over the map, and they may be riskier actors than the regulators would like. Is there any concern on that front, I guess, that the risk of the portfolios is growing?
No. We're all regulated by OSFI. They have they use different lending standards than we do, but the loss rate in this area is actually quite low. It's profitable business. It's just business that, and I think I said in the letter, we acknowledge it's profitable for them, even after capital. But we need to make sure that we're not jeopardizing the future of the Canadian economy. And then we were concerned that's what we were doing. So no, we have the best financial system in the world, Amanda. The mortgage insurance system stands behind banks to make sure the riskiest part of the housing market is actually held by the government, because even the private insurers are government guaranteed.
We say this, that we have the most stable financial system in the world. We have this level of household debt that certainly puts us in league with levels that should make us uncomfortable. We could now, it's a slightly different story, but we could now say, our personal share of government debt is also at incredibly high historic levels. should we not be concerned about stability when we think about that household indebtedness?
Oh, it's not. I don't think it's a stability question, sincerely, because household indebtedness is generally that debt sits on the government's balance sheet one way or the other. It's economic growth we're concerned about. It's the drag of people having taken future consumption and spent it today and tomorrow on interest charges. And that will slow us down in the future. And that's the thing we should worry about. Yeah, I sincerely don't think we have a financial stability problem in Canada.
Do you think we have a growth problem, or potentially could have a growth problem?
I really, really do. You know, the Bank for International Settlements, the IMF, Bank of Canada has done a lot of work on this. And the suggestion is that at levels that are way below current debt levels in Canada, economic growth starts to drag. We are like 50% above that threshold now in Canada, a long way above it. And so we will have debt slowing down our economic growth. Certainly that's the case.
And yet we need our economic growth to help us manage our debt. What's the balance that you would advocate for, just in terms of, I know this takes you a little bit outside of your current purview, but in terms of a government that needs to offer up restraint, or a vision of restraint, but also a vision of economic growth above our historical average, right, to get us out of this, the deficit?
So successive finance ministers of all colors that have been in government in Ottawa have progressively rolled back the insurance standards as a way to, you know, it could have been worse, I suppose, is the good news. And we need to get onto the back of this pandemic. Economic growth right now is coming from government spending and fiscal stimulus. That's proper. But what we really need is to get the pandemic behind us and have confidence restored in the economy so that people get investing again, and we get some unemployment that's going to have to work its way through behind us.
We have seen remarkable recent resilience in across housing in this country in terms of home sales. There's maybe a whole variety of reasons for that. What do you think drives it? And I ask you that in the context of, what are you looking for that would see that stop? In other words, the support for that stop beyond the government support we talked about. Are there other factors at play here that are keeping the market more buoyant than it deserves to be?
Certainly, one is just supply. It is hard to supply houses, and any response in demand goes straight into prices. So, you know, we announced yesterday, the government of Canada announced a $1.2 billion rapid housing program, which is targeted at people who are unemployed. That's supply. Our rental construction financing program has been massively successful. We've got to do, you know, that sort of thing and increase supply. The other, you know, we're seeing a behavioral phenomenon, of course, where people are, in general, selling condos and moving out to the suburbs. Young people are figuring out that they don't need to live downtown anymore to go to work because they're not going to their offices. If that's something that persists, there will be a demand for housing in the periphery of cities and a supply of condos, and some of that's showing up. At some point, the difference between the price of condos and single-family homes makes less sense, and people go back to condos. The market makes its adjustment. But there is something going on with how people choose to consume housing, as it were. And that we don't know how long that's going to last, or if it's going to last. It's really it's path dependent. It depends on how long this pandemic lasts.
And I guess whether even should the pandemic end, do some of these behaviors stay with us? From kind of a housing market point of view, how long do you think is it for those kinds of trends to show up? When do we know if people will work remotely, even if they don't have to?
Yeah, people, you know, I think the general trend in commercial space has been some of that anyway. This has accelerated it a bit. You know, the longer the pandemic lasts, the more people adjust to this kind of behavior, and therefore the less likely they are to go back. You get through a couple of years of this kind of thing, and my guess is it becomes pretty rote, pretty trained that this is how we're going to work. I don't quite, this is an opinion, I don't think that's the case. I don't think the introverts have won the war on hugs and isolation. You know, I think some of us will want to go back to offices, but some will stay away. Yeah.
You know, I'm trying to remember when you raised the real kind of call on supply, but I feel like it was a speech you gave in Vancouver in maybe 2017,
yeah, that's probably right.
Early 18. And your message was, you know, stop talking about you're worried about hot housing markets and start building, you know, supply. Densification is a big theme, right? That would get us there. Where are we on this on the supply side? I mean, because one of the affordable housing, rental units that families could actually afford to live in, it's not the sexiest part of the housing conversation, but it is, of course, one of the most important parts.
Well, this rapid housing initiative that was announced yesterday is a response to mayors, to provincial premiers all saying we need your help, federal government, and we're a little strapped. And we understand now the value of a house even more, right? It's a shelter, of course, but it's also protection from a pandemic. And we know that people who are homeless or who live in tight accommodations, in particular, people in long-term care, have been particularly affected by this. And so the value of housing in and of itself is something we're more aware of. And I think that will stimulate more supply. I think governments see that. I think the private sector sees it. And I'm hopeful there's more of that coming. I do think maybe it's not sexy, but I do think the conversation shifted.
Obviously the dollars earmarked is incredibly important, not to downplay that. But there's a long way from money flowing to actually seeing projects get built, and a lot of kind of jurisdictional fights and people that stand in the way, let's face it. But are you confident that there's been a change in thinking around actually getting, affordable rental, for instance, actually built?
Oh, look at Vancouver since 2016. There's been a massive shift in the pace of approvals in Vancouver, quite clearly since 2016. Now, they're still catching up to a lag before that. In Toronto, the mayor, the deputy mayor are talking about housing quite consistently. Mayor Wilson in Ottawa, Don Iveson in Edmonton. Maybe it's just what I'm paying attention to be fair. But municipalities really do understand their responsibility. It's not all on them. And it's too easy to point our fingers at mayors and city councils and say you're too slow. There's land banking going on by developers. All sorts of different manifestations that slow down the supply of housing.
There are a couple of really interesting factors on the demand side that the pandemic has changed, and hopefully temporarily. But one of them for Canada has been immigration. I guess globally, that's true. Every country will see lower immigration this year. It's been a huge driving factor for Canada in recent years. Certainly in as we know, in 2018 and 2019, massive economic growth, huge source of demand for new housing. So where do we fall now that we know that this year is not going to be good and we don't actually know when it'll pick up again?
It's one of the factors behind our weakening house price forecast, because that demand, and it's not just demand from immigrants, it's demand from foreign students too, a significant source of income for our universities. Now, some of them will do that virtually, but they're not coming here to rent homes. And that demand has come out of the market, and I don't think the market's quite caught up to it. There's been a bit of a behavioral factor, we think, in the market, which there's a technical term for it. It's called FOMO. People are just chasing. It's like momentum investing, right? They're chasing something, and that energy doesn't sustain itself in the longer run.
And I guess the other COVID-related aspect of this, and it maybe actually even have some other macro elements, but the foreign investment aspect of our market has been an important one, especially for some key places, right? Those hot markets. But Toronto and Vancouver, I think we can say especially, has benefited, or not, depending on your point of view,
or not, depending
but from
on
massive foreign investment. And I know there's been some policy adjustments there to try to make sure that our market's not distorted by that investment. But for those who are benefiting from, the appreciation in value, are we likely to see a return to that, the more free-flowing capital of a couple of years ago?
We have an open economy. We're an economy that's built on people who come from other places. We're a country that's built on people who come from other places. I think that does come back, especially if our dollar weakens. It'll be even more attractive. That's just who Canada is, and we're a wonderfully attractive place for people of different colors and ethnicity and preferences. And that's something I think to be celebrated about our country. It does result in increased demand for housing and higher house prices. And unfortunately, sometimes the dialogue is an us-them dialogue, which I think is quite unhelpful. We've always had foreign investment in Canada. We've always had foreign investment in housing.
And that's something that we should continue to. I guess that just to put some context around it, I think it's probably a relatively small but fairly influential part of the market, if I could put it that way, where it's sort of the investment for investment purposes. So the empty houses that you see reports on in British Columbia, for instance, that's not a concern at all.
Sure, it's a concern, but my mother is one person who lives in a 3-bedroom house too. That's a version of an empty house. So, we have housing capacity. It's just not where the people want to be, or they're not available for rent.
Right.
We're actually looking at CMHC's working on an app where we're going to try and match people who are overhoused with people who need housing. And, that's just one thing we can do, thinking innovatively and differently about housing.
All right. We look forward to seeing it. We appreciate your time today, Evan. Appreciate it.
My pleasure. Thanks, Amanda.
Thank you. That is Evan Siddall, CEO of CMHC. Thank you for joining us for this first session of the Bloomberg Canadian Fixed Income Series. A special thanks to all of our speakers and our moderators, and a big thank you to our sponsor, National Bank, and of course to you, our engaged audience. Please do continue to join us. The series will continue for the next month. And coming up in about a week's time, we have a very special look at a cross-section of Canadian industries, from real estate to mining to financial services. We have former UN Ambassador Marc-André Blanchard with us. That is on September 29th at 11:30 a.m. Eastern. Remember, you can catch the series there and also on Bloomberg.com. And do follow us on Twitter @business. Thanks for watching.